Good evening, class, and welcome to our performance management class for tonight. Today, we are focusing our attention on the topic called throughput accounting. What is throughput accounting all about? What are the assumptions in throughput accounting? How is inventory and operating expenses accounted for, and the profits in throughput accounting? How can we compare throughput accounting with absorption costing and marginal costing? Why should we deal with constraints using throughput accounting? And what does the performance ratios arising from throughput accounting, what does it tell us? All of this we are going to find out today. Now, the nature of throughput accounting. Throughput accounting is not really a costing system at all, because with costing, no costs are allocated to units of production with the exception of material cost. So because throughput accounting allocates material cost to production, and so this is not the conventional types of accounting or costing. With the traditional costing system, the main focus of attention is on cost and how to control and reduce cost. You see, when we are learning curve, we usually say that at the time when learning becomes steady, you can predict your costs and you can reduce them. With traditional costing system such as ABC, we are trying to reduce costs. With throughput accounting, the main focus of attention is on how to achieve the goals of the organization in its entirety. And so, for profit-making companies, the goal of the organization will be to maximize profit. So that is the main thing for uh, throughput accounting. It is to achieve the organization objective, which may not be profit making. Throughput accounting is associated with something called the theory of constraints. So you see here that we'll be talking about constraint a lot when dealing with throughput. This is a theory that states that an entity always has a constraint that sets a limit on the achievement of its goals. So we are learning limiting factor and linear programming. We talked about constraint, right? Now, when we are talking about throughput accounting, we will be examining again this constraint because it is linked and associated with the theory of constraint. So the task of the management will be to identify what this effective constraint is. So what it means is that if we have more than one constraint, which one of them is having the most constraint? Let me give an example. Let's say you are having uh, a fuel line. People are queuing up to buy fuel. Now, which which queue or which filling station is likely, or which of the filling station stand is likely having more queue? That is where the major constraint is. So it means that there may be some constraint, but which one of them has more constraint? So that's where you would point your attention to. Or it's just like, you are having to pass through the Third Mainland Bridge and there was heavy traffic. Which lane has more traffic? That will give you the effective constraint. Now, we have to maximize the performance of the entity in achieving its goals within the limit of this constraint. So it means that identify which one that has the effective constraint. All your activity will depend on the performance of that constraint. It's just like having people to run a relay and all the people having to run in a relay, 4x4 relay or 6x6 relay, and your effectiveness will come as a result of your management of the weakest runner. So, who is the weakest runner? Who is the slowest runner among you? That is your constraint. So, um your effectiveness, your performance will depend on how the slowest runner performs. So that's it. Then we need to maximize the performance of that slowest or that busiest queue. We need to improve the activities there. Let's say you are in a bank and you have maybe people are queuing in different customer service, and you see one queue very long. You now try to, like what the bankers used to do. They will now come and start asking people in the line, what do you want to do? What do you want to do? They now help them in the line. So the queue is reducing. You are trying to improve or maximize the performance within that constraint. Now, when you look for ways to improve that constraint so that the the whole system will also run faster. But the thing is here that the moment you block that hole, you now make it start going better, another constraint will come up. As you are solving one, you are creating another constraint. So you continuously look for ways to improve the overall performance of the system. Now, assumptions in throughput accounting. Throughput accounting is based on a number of assumptions. In traditional marginal costing, it is assumed that labor costs are variable costs. So now, I'll be highlighting some of those things that you need to take note when you are dealing with uh, throughput accounting that is so peculiar about throughput accounting. The first one is that in traditional accounting, labor is seen to be variable. So direct labor is variable cost. But in practice, it is not usually correct. Why? Because even your production workers, you pay them salary. You don't pay them wages. You pay them monthly salary. And sometimes even when there is no work, there is idle time, you still pay them for the idle time. So in throughput accounting, labor is fixed. So labor is not a variable cost in throughput accounting. So labor is fixed. Another assumption, the only variable cost in throughput accounting is purchase cost of material and components purchased from external suppliers. This is the only thing that is truly variable because materials that you buy are inanimate things. You they increase with the level of production. They are not fixed. The amount of the amount of flour you spend for 10 bags of rice or 10 bags of flour for making bread will be different from what you spend in making maybe you want to make 1,000 loaves. The number of bags you spend on will be different from what you would do if you're spending 100,000. But you see, labor, whether you work overtime, you work under time, you work per unit or piece rate or hourly rate, you are paid a fixed and even a guaranteed sum, meaning that even if there is no work, you are sure that you have a minimum amount that you must take home to. So you see, labor is fixed, material cost is variable. The third assumption, a business makes real profit by adding value. And now value is added by selling goods or services to customers whose market value is more than the cost of the material that goes into making them. Value is not added until the sale is made. So you simply have the goods in your possession. Yes, you have stock available for sale, but have you added value? The system has not gotten value until someone makes that purchase from you, then value has been added. Now, value added should be measured as the value of the sale minus minus the variable cost of sales, which is the cost of material. That is what we call throughput. That value that is added is called throughput. And so, just like we have contribution in marginal costing, right, which is sales minus variable cost, in throughput accounting, it is called throughput, that value, which is sales minus cost of materials, which is the variable cost. All right, so let's look at throughput, inventory, and operating expenses. Throughput accounting is based on three concepts. One, throughput, we'll talk about it. Inventory, which is investment, and operating expenses. So let's see them one at a time. What is throughput? Throughput can be defined as the rate at which an entity achieves its goals, measured in goals units. So when an entity achieves its goals unit. So what is the goal per unit that you have achieved? That is the throughput. What is the goal per unit that you have achieved? That's your throughput. In a not-for-profit organization, it could be measured in non-financial terms, maybe non-financial goals. How many customers were you able to satisfy? So yeah, you're now looking at how many repeat customers do you have in a period? How many five-star rating do you have? How many problems were you able to solve? Not for profit organization. The goal for profit organization, the goal is profit. And we said contribution is equal to sales minus total variable cost. You agree with me, right? Now, throughput differs from contribution in the sense that the only real cost that is variable is material cost. Whereas in marginal costing, material and labor costs are variable. And so in throughput, what we call throughput or that value added is sales minus the cost of raw materials and components. We've emphasized that. So that is one of the things that you should never forget. Throughput material is the only variable cost. What about inventory or investment? Inventory or investment is where all the money in the business is tied up, and it is tied up in inventories of raw material, inventories of work in progress, inventories of finished goods. So in a manufacturing entity, raw materials in the form of say flour, that is raw material. Finish work in progress could be the maybe the bags of flour that you put into the milling machine is still in process, or the bread that you are, the dough now rather is being kept to rise. That is still a work in progress, or it is still in the oven yet to be out. It's work in progress, or it has come out from the oven, and if you are to be slicing it, of course you can't slice it hot, and you are keeping it to cool. It is still work in progress. Now until that bread is wrapped in the package ready for distribution, it is still work in progress. Now the bread is now put in a wrap where it can be sold. Although some people want to sell hot bread, and so they will not slice it and they put it in the wrapper. Now these days, some people don't even put bread in wrapper. Like I know of a bakery where if you want to buy bread, you have to buy the wrapper too. So that time that it is ready for sale, it is finished goods. But before that time, that is work in progress. So if your capital or investment is not tied down in raw material, it's either in finished goods ready to be sold or work in progress. Now this time it has not been sold. So because it has not been sold, it is inventory. The term investment is normally preferred to inventory because it includes the amount of capital tied up in making the product before selling it to customers. Of course, it will be sold to customers. So before it is sold to customers, it is inventory or investment. Investment includes not only the amount invested in inventories, but also investment in non-current assets. So not only are we looking at inventories or stock, we are looking at non-current assets too that are also being invested in. All of these are your investment. Now you can see now, inventory is a type of investment. We have said inventory could be three types: raw material, work in progress, finished goods. Is form part of the investment. This is your current assets. Then your non-current assets also forms your investment. Inventory is eventually converted into throughput. Inventory is eventually converted into throughput. What is throughput? Throughput is sales minus the investment in inventories. But until that investment is sold up, the capital is being tied up and nothing is held. So when inventory is sold, a throughput is created. If it is not sold, it is just an inventory. No throughput is created. All right. So let's look at operating expenses. Operating expenses are all the expenses incurred to produce the throughput. They consist of all the costs that are not variable costs. And so it includes labor. So, this operating cost is just like the fixed cost in marginal costing, whereas your inventory is just like your variable cost in marginal costing. So your fixed cost is this operating cost. They consist of everything, including labor cost. So bear that in mind. Now look at an example here: profits and throughput accounting. Now we see sales. If we are giving sales 800,000, so as soon as sales is made, a throughput has been, or a value has been created. Now when you minus the cost of raw materials from it, you get throughput. Now when you remove your operating expenses, which includes labor, in throughput, operating expenses is our fixed cost, you get your net profit. So what you should be looking at now in throughput accounting, you know, associate it with marginal costing, and be looking at throughput the way you look at contribution. The only difference here is labor is not included in the variable cost. Labor is pushed to operating expenses. Now we've looked at three things here. We've looked at what is throughput. We've looked at the we looked at throughput. We look at inventory, and we've looked at operating expenses. Now, what about the value of inventory in throughput accounting? What is the value of inventory in throughput accounting? Inventories do not have value except the variable cost of the materials and components. We said inventories here is not valuable except we are talking about materials and components. So you see, uh, in throughput accounting, this is what you'll be hearing: inventory, material cost. Even for work in progress and inventories of finished goods, the only money invested is the purchase cost of the raw material. No value is added until the inventory is sold. Now, what do they mean here? Work in progress. Although, yes, you know that labor has been added to work in progress. But the thing here is, nothing has been created, no value has been created if it has not been sold. Your finished goods just lying in your office, especially if it has expiring dates, no value has been added if it is still there in the shelf. The only cost that is tangible, that is worthy of note, is the purchase cost of the raw material, because you actually spent money and they brought it. So that's the only cost. So in throughput accounting, all inventories are valued at the cost of raw material and components and nothing more. So secondly, it should not include other costs, not even labor costs. It is impossible to make extra profit simply by producing more output. Extra profit can only be possible if that extra output is sold. So we keep hearing material cost is most important thing in inventory. Value is not created until your goods is sold. These are valuable points you should bear in mind in throughput accounting. Now let's compare throughput accounting with absorption costing and marginal costing, and let's see the difference between this accounting method. Now, let's look at it here. A company makes 1,000 units of a product during May and sells 800 units for 32,000. There was no inventory at the beginning of the month. Cost of production were raw material, direct labor, fixed production overhead, other non-production overhead. Now, we are asked to calculate the profit for the period using absorption costing, marginal costing, throughput accounting. And we are told to assume, for the purpose of absorption costing, that budgeted and actual production overhead are the same and there are no under and over absorption. Now look at how it's going to be done. All right, so let's look at it here. Let's look at how to solve it here. Let's do it on the whiteboard here. I'll say this is performance management. So the topic here is throughput counting. And now we are comparison between absorption costing marginal costing and throughput accounting. All right, so let's begin. So let's just call here, this is, we are asked to look for profit, right? So this should be absorption costing. I'll call it AC. This is marginal costing. This is throughput accounting. So this is the methods that we are asked to use to get our profit. All right, so the first thing to do here is, what's our sales revenue? I'm supposed to use a different color. So sales revenue. So what's our sales revenue here? We sold 800 units for how much? 32,000 naira. So the 32,000 is our revenue. So this 32,000. So the three of them is 30. What am I writing? 32,000 okay. So the next thing here, for absorption costing, what do you normally do? We will look for um, gross profits. So let's see, one of them we should do is when we less direct material. Direct material cost. What is direct material cost? Raw materials is 6,000 naira, right? 6,000 naira. So direct material cost, we have 6,000 here, and we have 6,000 here. We also have 6,000 here. So this is your direct material. And we said for throughput accounting, when we have direct material cost, when we less it, what do we have? 32,000 minus 6,000, we have 26,000. 26,000 is, so put dash here, dash here. Our throughput is 26,000. Okay, then we are doing labor costs, less labor costs. Cost, labor costs, how much is it here? Labor cost is 8,000. So 8,000 is here. This is also 8,000. Then here is also 8,000. You know, when you less material and labor, what you get in marginal costing is called contribution. So 26,000 minus 8, 26,000 minus 8,000, that will give you 18. So this 18,000 here is your contribution. This is your contribution. Okay, so after contribution, what do you normally have is your fixed cost, isn't it? So we have fixed overhead, fixed production overhead. So let's get fixed production overhead. We have production overhead. How much was that again? It was 10,000. So this is 10,000. This is also 10,000. This is also 10,000. Okay? When we less this, what do we have? We have 18,000 minus 10. So that should give us 8,000. That should give us 8,000. That should give us 8,000. Of course, sorry, let me check something here, the way they did it here. I want to follow the standard the way they did it here. Okay. Still the same thing. Okay, let me use this one to explain what I was trying to do there. So this is raw material, direct labor, and fixed overhead. I was trying to do that, yes. Okay. Is this closing stock I'm coming to? That is what I want to see. So 200 per 1,000. Okay. All right. So look at what is happening here. Let's remove the closing stock. Closing stock. Okay, so closing stock. Closing stock, you bought um you bought 1,000 units. You bought 1,000 units and you sold 800. So that means 200 is remaining, isn't it? So that's it. So your closing stock here should be 200. Now, what is the value of the closing stock? So all this cost of production, all these production costs ranging from direct material, direct labor, and fixed overhead, production fixed overhead. When you add them together, let's add them together. We have 6,000 plus 8,000 plus 10,000. Uh-oh, I went to do 80,000 minus 80,000 that I did before. And let me add 8,000, which is the correct thing. This is 24,000. So this 24,000 that is incurred was used for 1,000 units. How much proportion of this 24,000 is to be given to 200? So that's why you will say 200 all over 1,000. Now multiplied by 24,000. So when you multiply it by 24,000, so you have 24,000 times 200 that divided by 1,000. And that is how you have this 4,000. Is it 4,800 here? 4,800. So here should be 4,000, 4,800. That is your closing stock, as can be seen here. 4,800, which is this here now. Now, why is this one 2,800? This is because it is just material and labor. So, material and labor is 6,000 plus 8,000 gives you 14,000. So if you say multiplied by 200, sorry, multiplied by 200 divided by 1,000, that will give you 2,800. So look at what I'll be doing here. I will say multiplied by, this is uh, 8, 6 plus, that is 14,000 here. So this one will give you 2,800. Then the last one will just give you the material cost, which is 6,000. So all you are doing now is 6,000 multiplied by 200 divided by 1,000. That will give you 1,200. That is this 1,200 that is here. So if you look at it here, you are also having the same thing. So when you less them, you will now have cost of sales, gross profit, like that. So in this case now, you are having gross profit. So you have Okay, I was wondering why it was going to give me negative. We have here 8,000 minus 4,800. That gives you 3,200 here. 3,200. Of course, we will not call it a profit. Somebody is asking a question. Somebody is asking why are we using only 6,000 for throughput, because material cost is only the variable cost. It's only the material cost that we are after. It's only material cost we are after. So your production cost is your material cost. Okay, whereas in marginal costing, production cost is your material and labor. Whereas in absorption costing, your material cost, your labor cost, your production overhead. Okay, so we now have the fixed overhead cost. The fixed overhead cost we have not used here, or other non-production overhead, which is 5,000. Okay, sorry, we have used 10,000, which is 5,000. We now have other overhead costs. We have 5,000. We have 5,000. 5,000. So I think the way they did it here in this book here is is far better. I have missed something in my own here, so I'll correct it now. The sales here is 32,000 as stated here, 32 in all of them. Then your production cost here happens to be your material. Yes, that's the same thing here. Then we have labor cost. Labor cost is not included as material cost in throughput. Labor cost is not here. Okay, and labor cost is a marginal cost, and in absorption cost, the labor cost is there. Then we have production overhead. Production overhead of this 10,000 is only in absorption costing, never in marginal, never in throughput. When we add all of these, we have 24,000 as we calculated 14 and 6. It is based on these figures we calculated our closing stock, and I said 200 over 1,000 because 1,000 was used in making these costs. This 24,000 naira that was for material, labor, and production was used in producing 1,000 units. This material and labor, which gives us 14,000, was channeled on 1,000 units. This 6,000 naira was used to buy materials to make 1,000 units. What is your closing inventory? Your closing inventory will be valued at the remaining 200 out of the 1,000 multiplied by what the value of your production is. This gives us 480, this one gives us 280, this one gives us 12. So when you remove 24,000 from 480, you have 19,2, which is your cost of sale. This is still cost of sales. But now we have a gross profit. Our gross profit will be 32,000 minus 19,2, giving us 12,8. Cost of sales. We don't usually use cost of sales here in marginal costing. So we usually say our contribution will be 32,000 minus 11,200. That will give us 2,800. Whereas in throughput, we have 32,000 minus your cost of sale. Your cost of sale is usually your raw material minus the closing stock, which is 48, giving us 27,200. Then now we start removing all the expenses. We have non-production expenses. 5,000 is common to all of them. We have the fixed overhead. This 10,000 that was used here, you see it was used here, and now it is being used here. Okay, then it's also used in throughput. Then your labor cost was used here, so you can't repeat it again. It was also used here, so you can't repeat. So it was not used in throughput, that is why it is being used here. And your operating expenses happen to be 5,000, 15,000, 23,000. So your net profit happens to be 7,800, which is gross profit minus your operating expenses. Whereas this is 5,800, which is 28 minus 15, and here this is 4,200. That was what I was trying to do. If I were to calculate this thing now, um, if you say, let's see whether we'll get the same thing. I know I will miss somewhere. 8,000 minus 28 minus 5,000. I missed it up somewhere. Minus 5,000. That gives me 200. I missed it somewhere. Let me try the last one. 8,000 minus 12 minus 5,000. Of course, I missed it up somewhere. Okay. I mixed up the calculation somewhere. So let's make do with what we have here. So you can see that the difference in this net profit is how we value your closing stock. That is what matters. The difference is due to the differences in inventory valuation. How we value our closing stock. Because you see everything here, every element that was used in absorption cost was used in um, marginal costing, was used in throughput, the same figures. But the only difference here was what we declared as our closing stock. And you see how we got 4,800. It is because these were our production costs. Production costs happen to be material, labor, and production overhead. We we now use it to get cost of production. We now use our closing stock to be valued from that. Whereas here, marginal costing, we have only material and labor as our uh, production cost. That's why it is smaller. And we have throughput, only materials is our production cost. And so our inventory will be valued at the material. So that's the difference. This figure here is the key difference, which now made our cost of sales to be different. So that's just the difference. Constraints and bottlenecks in the system. Constraints and bottleneck. Throughput accounting is derived from the theory of constraints, which is based on the view that every system has a constraint. A constraint is anything that limits the output from the system. So we said, if you cannot produce your maximum, you cannot satisfy all your customers, you cannot solve every problem, it means you have a constraint. If a system had no constraint, its output would either be zero or the system will continue to produce more and more and more output without limit. So every system must have a constraint. If it is not capacity to produce, it could be capacity to store. If it is not capacity to store, it could be manpower to produce. If it is not manpower to produce, it is machine hours, labor hours. It could be capital, but there must be a constraint. Therefore, for any system whose output is not zero, there must be a constraint that stops it from producing more output than it does. So normally, if you don't produce anything, that means the system has no constraint. But if you must produce, that means you should have constraint. It's just like saying now that I am in a class teaching. What is my constraint? My constraint could be time. Constraint could be network. Constraint could be other engagements that I am supposed to do, right? Constraint for a manufacturing company might be caused by any of the following: external factors such as a limit to the customer demand for the product that the company makes. So you are making a product or a component, your customers have a limit to what they can buy from you. It could be weakness in the system itself, such as shortage of key staff, key resources. Maybe you don't have enough manpower, skilled manpower, or maybe it is something that will need expatriates and you just have only one, whereas you should have like five, six, or you have capacity limitation. It's something that, just look at, okay, take for example Zoom now. If I'm supposed to have this class, let's say I have 200 students and my Zoom can take 100, that's it's going to be a capacity limitation, right? Weakness in the system's control, such as weak management. So all of these could cause a constraint. So in a manufacturing system, constraint is called bottleneck. So you see here, bottleneck, that's the language used in throughput. So when you are seeing a question and you see bottleneck, what should you conclude about that question? It is a throughput question. Sometimes they might not use bottleneck, they might use limiting factor. They might also use constraint. So you see here, if you're looking at a question and you see constraint, limiting factor, your mind should go to three or four topics. You should go to throughput, you should go to limiting factor, you should even go to linear programming, because these are the topics that have limiting factor. You could even go to make or buy with scarce resource. All of these are constrained. So manufacturing system must have a constraint. Now in throughput, this constraint is called bottleneck. So bottleneck might be shortage of materials or shortage of machine time, as I said before. Now, how do you deal with this constraint? The management of the business operation should focus on dealing with the key constraint. I said before, if you have constraint, it may not be one constraint, it may be two or three constraints, but look at the key constraint. And I said the key constraint could be where you are having more queue or where the system is slowest. Go there and deal with it. So go there and deal with it. They should focus on dealing with the key constraint. The output of a system is restricted by its key constraint. So I said before, the success of a relay is hinged on the performance of the slowest runner among them. So the output is restricted by its key constraint. A, 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 a wall or a bridge is standing. The, the bridge can only keep standing as long as the weakest pole carrying it has not collapsed. They said a chain is as strong as the weakest link. And so that weakest link is what it should be given more attention. Management must identify that. Then the action by management would be to improve operational efficiency. You have to apply operational efficiency on that weak link. So for example, measures to improve labor efficiency are a waste of time if the key constraint is a shortage of machine capacity. So if you are trying to improve labor efficiency and the problem is machine capacity, all you need to do is to solve your machine capacity. The key constraint limits throughput, and we said the key nature of constraint might be limitations on sales demand, inefficiency in production, which could include stoppages, maybe because there's machine downtime, waiting for materials to come, hold-ups caused by wastage, scrap items. We can also have limitations arising because of unreliability in the supply of key material and the key such shortage of key material. So you are waiting for a key material to come. Without that material, you cannot proceed. And they brought inferior products, or it is short, or it is on the way. Or you could have shortage of key skilled labor, right? Then management should identify the key constraint and consider ways of removing or easing the constraint so that the system is able to produce more output. I'll give an example of maybe the hold up. You find out that in the third mainland bridge, where hold up used to be the peak, there are different lanes. And the traffic people decides to make a lane which they see as the longest. They now try to manage it, and now that lane is now moving. You find out that uh, they have solved that problem because they managed to identify that problem and they concentrate their effort and solved it. But when they solve that problem, another key constraint will now come up. So it means that that one that used to be the slowest line is now becoming the fastest. Somebody else will take its place. Somebody else will now become the slowest. So the new constraint, the new key constraint will now need to be identified. And management will now leave that one they have solved. They will now start solving on the second one. When that one is now moving, another constraint will now be formed. That is how management will go, solving the constraint until the efficiency is improved. And as they are solving, another one is always created. But the aim here is to improve the efficiency of the whole system in question. Now, what is the relevance of constraint to throughput accounting? Goldratt argued that if the aim of a business is to make money and profits, the most appropriate method of doing this are to what? Increase your throughput. What do we say is our throughput? Throughput is sales minus material cost. So when you increase your throughput, you are increasing your profit. It's just like saying in marginal costing, when you increase your contribution, you are increasing your profit. Now, if you increase your throughput, you are increasing your profit. Now, normally, if your throughput is enough to cover your operating expenses, if it is enough to cover it, you may break even. But if your throughput is more than your operating expenses, that means you have increased your throughput and you are going to make money or make profit. Another way to improve or make money is to reduce your operating expenses. Now, assuming you cannot increase your throughput by increasing your sales, if you cannot increase your sales, because one way to increase your throughput is to increase your sales quantity or to increase your selling price. Maybe you cannot touch your selling price, and maybe the demand from your customers, you may not be able to sell more. You need to reduce your operating expenses. If you reduce your operating expenses, your throughput will increase because your cost now is now little lower. Your throughput or your profit will increase. So your throughput may not increase, but your profit may increase if your operating expenses is reduced. Another one is to reduce your investment. For example, by reducing inventory levels. So that inventory level is what makes up your variable cost. So reducing your inventory level, your variable cost will reduce. If your sales is not increasing, if your variable cost reduce, it will increase your throughput. All right. So this Goldratt also argued that the most effective of these three ways of increasing profit is to increase throughput. And throughput can be increased by identifying the bottleneck in the system and taking action to remove them or ease them. So you see here, throughput is not just only in calculating sales minus material cost to get throughput. You need to find which is the bottleneck and take steps to ease them. Right. Then we have here performance measurement ratios in throughput accounting. So this will help us to know whether we are really achieving our objective in throughput. There are several key performance measurements in throughput accounting, and one of these is net profit. Net profit is simply your throughput minus your operating expenses. Normally, in marginal costing, we will say net profit will be contribution minus your fixed cost, right? Or which is operating expenses. In assumption costing, we will usually say net profit will be gross profit minus what? Minus your operating expenses. But in throughput accounting, it is your throughput minus your operating expenses. An objective is to increase net profit. So if you want to improve your performance, is to increase your net profit, which is through the throughput. Now, performance can be measured using the following ratios. One of them is return on investment. We will see the formula in a moment. Return on investment. So return. So what is returns? And what is your investment? Another one is throughput accounting productivity. Then we have throughput per unit of the bottleneck. Remember when we said throughput per limiting factor? That is the same thing here. Then we also have operating expenses per unit of the bottleneck. Then the chief of them all is the throughput accounting ratio. Now let's see them. Return on investment. Returns usually is profit. Net profit is your returns divided by your investment over times 100%. That is the formula for returns on investment. Now, if you want to increase your return on investment, what should you do? Increase your net profit. If you increase your net profit, let's say, okay, let's give a practical example here. Let's use a practical example here. Let's say your net profit here is 5,000 all over. Investment is 50,000 times 100. So that will give you 10%, right? If you want to increase your 10%, want to increase it, what should you do? Increase your profit. So let's see now, assuming now that your profit is 6,000, then your investment is still 50,000. Let's see whether it will increase. So let's see, 6,000 divided by 50,000 times 100. See, this is now 12%. So your returns on investment has increased because what? You have increased your net profit. Now, assuming that you cannot increase your net profit, how else can you increase your returns on investment? Now, look at it now. You have 5,000 still, but you have to reduce the investment. And let's say you reduce this to 40,000. So let's see whether it will increase our net or our return on investment. We have 5,000 divided by 40,000 times 100. See, this is now 12.5%. So you, you can increase your returns on investment either by increasing your numerator, which is your net profit, or reducing the denominator, which is your investment. Right? The next one here is throughput productivity. Throughput productivity is measured as your throughput divided by your operating expenses. Your throughput divided by your operating expenses. Now, how can you increase your throughput productivity? By increasing your throughput. How do you increase your throughput? It's either you increase your sales revenue by increasing the quantity or by increasing the price or both. If you cannot increase your throughput, then you need to reduce your operating expenses. It could be reducing your labor cost, it could be reducing your production overhead. Then we have throughput per unit of constraint. Throughput per unit of constraint. Now, one of the advantage of throughput accounting is that it treats labor cost as a fixed cost. Yes, we've mentioned that a million times. In many manufacturing companies where the production process has been automated, direct labor costs are not a significant part of the total production cost. So you see now, it now becomes a fixed cost. However, conventional costing systems that treat labor cost as a variable cost and assume that variable overhead vary with labor hours. In addition, fixed overhead might be absorbed on labor hour basis. It's often assumed that performance will be improved by improving labor efficiency. So that is what traditional accounting system is saying. That is what marginal costing also is saying. Mostly traditional accounting like absorption costing, they are saying that performance of the factory will be improved by improving efficiency. But we are saying here that throughput accounting is challenging that approach, and is saying that labor does not have anything to do with performance. It's not adding to the throughput. So net profit will be improved much more effectively by identifying the constraint on the activity and seek to maximize throughput per unit of the constraint. Now remember how we usually look at the limiting factor. When we do limiting factor, we now said contribution per limiting factor. We now did ranking. When you are now doing ranking, but this time around you are using throughput per bottleneck, and you are now doing ranking to know where you should identify where you should need more improvement on. Then we have the throughput accounting ratio, which I said it is the king of all. The throughput accounting ratio is the ratio of throughput in a period per unit of bottleneck to operating expenses per unit of bottleneck. So you are saying two things now. Throughput is simply your selling price minus your variable cost per unit. That will give you throughput. Now, if you know your bottleneck, if you know the bottleneck, that key resource that is the bottleneck, go and look for the throughput per hour. Since we are using hour, let's assume that it is labor hours. Let's assume that it's labor hours, right? If it is that particular labor, which is the weakest, how much per hour are you paying that person? It's just like the weakest runner in the race. How much is he earning? And what is the cost for him? You look for the throughput per hour of that weakest link. Then go and look at the operating expenses. Then go and charge it per hour of the weakest link, which is the throughput, which is the bottleneck rather. So when you look at the throughput per hour over operating expenses per hour, all of them of the bottleneck, you have a throughput accounting ratio. Now, when you have a ratio, you can either have a ratio of 1, you can have ratio of 2, you can have 0.5, you can even have negative. What do they all mean? We'll get to see that. Let's look at this question here. A business manufactures Z, which has a selling price of 20 naira. The material costs are 8 naira per unit of product Z. Total operating expenses each month is 120,000. And now we are told that machine capacity is the key constraint. So you have been given your key constraint as machine capacity. So this is your key constraint. And there are only 600 machine hours available. 600 machine hours available. And it takes 3 minutes. 3 minutes of machine time. So I will say 3 minutes. Now, can you convert 3 minutes to hours? So you simply say 3 over 60, which is the same thing as saying 1 over 20 hours. So it takes 1 over 20 hours time, machine time, to manufacture each unit of product Z. And we are told to calculate the throughput accounting ratio. So now this is what we are going to do here. Our throughput, we are told that throughput is what? Sales. So this is our selling price. This is your SP. SP is 20 naira. Then we have variable costs, which is raw material. Raw material, which is how much? 8 naira per unit. So our throughput is going to give us SP minus VC, which is 20 minus 8, which is 12. So we have identified that our throughput is 12. That's what we've done now. Now, throughput per machine hours. So what do we do now? We said that it takes us how many minutes to make 1 unit. It takes 3 minutes per machine hour to manufacture each unit. So 1 unit, it takes 3 hours. So if this is your throughput, then we have um, bottleneck. Bottleneck per unit is how much? We said it's 3 over 60, which is like 1 over 20. So when we now say throughput per bottleneck, is as good as saying 12 divided by 1 over 20, which is as good as saying 12 times 20 over 1. 12 times 20 should give us what? 12 times 20 should give us 240. So this is your throughput per hour. So that's what we got here. The throughput per hour is 240. Okay. Now, what is your operating expenses? Your operating expenses happens to be 120. So your operating OPEX expenses is 120,000, right? 120,000. So therefore, OPEX per bottleneck is going to give me 120 divided by 1 over 20. So when you say 120 times 20, 120 times 20, that should give us 2.4. Okay, so sorry, that's not it. Operating expenses is 120, and we have only 600 machine hours. So that's what I should use. Beg your pardon. That's what I should use. So this is the operating expenses. This operating expenses was used throughout the whole 600 hours. So how much per hour? It should be 120,000 divided by 600. That will give me 200. So that will give me 200 per bottleneck hours. So that's what we got here, 200. So now what is our throughput accounting ratio? It's going to give us throughput per bottleneck divided by OPEX per bottleneck, which is going to give us what? 240 divided by 200. So when we do that, 240 divided by 200, that will give us 1.2. So 1.2 is your OPEX and your throughput accounting. That's what we got here. Okay. So now we are asked again, how might this ratio be improved? How can you increase this your ratio? To increase this ratio, it is possible to raise your selling price. So if you raise your selling price, if your selling price is increased and your variable cost is kept constant, what will happen to your TP? Your TP will increase. So you see, raise the selling price to increase the throughput per output. That's one. You can reduce the variable cost to still increase your throughput. So let's see whether that was even said. To improve efficiency of machine time use, so the manufacture product is less than 3 minutes. Of course, that's another way. So if you reduce the time, it takes to manufacture the product. We said it is 3 minutes. We said it was 3 minutes, right? If you can make it up to 2 minutes, so that 3 minutes, you make it up to 2 minutes. Assuming this is um, 2/60, that will give us 1/30. And 1/30 will increase your throughput. Then we now said, find ways of reducing total operating expenses. If you reduce your total operating expenses, what will happen? If this is reduced, then this ratio, if this is reduced, this ratio will also reduce, and it will increase your throughput accounting ratio. So you can identify it here, increase your selling price or reduce your variable cost if you can. That will increase your throughput. Reduce your expenses, and it will reduce this aspect of the operation. Now, all we are doing is anything that is cost, reduce it. Anything that is revenue, increase it. That way your throughput will increase. So that's it. Now, one thing I need to tell you here is that a throughput of 1 and above is usually very, very important. If you have a throughput of 1, it means that your your throughput accounting ratio, if it is 1, it means that your throughput is the same as your operating expense. If your throughput is the same as your operating expense and you have a TAR of 1, that is the break-even point in throughput. You are making neither profit nor loss if you have 1. But the moment you have more than 1, as in this case, more than 1, you have 1.2, you will make profit. Your net profit will increase. So you see why we need to increase our TAR. It means you have to increase your throughput. So if you have throughputs higher than your operating expense per bottleneck, if your TP per bottleneck is higher than your operating expenses per bottleneck, then you are going to make profit. But the moment you have less than one, if you have less than one, if you have less than one, it means that you are making a loss. If you're having less than one, you are making a loss. What about if you have zero? If you're having zero, it means no value was added. Your throughput, it means you didn't sell anything. For you to have zero, it means your TP here is zero. It means you didn't sell, or maybe you didn't purchase, so you didn't produce. You didn't produce for the year. It could be that your operating cost might be there, but the moment you have zero, it means the numerator is zero already. The denominator can never be zero. That means operating cost, like the fixed cost that is not factory related, was being incurred. Maybe labor cost was not incurred, but your fixed cost was incurred, and you didn't buy, you didn't sell. That is zero. Then you cannot have a negative ratio. You cannot have a negative ratio. If you have a negative ratio, what it simply means is that your variable cost was higher than your selling price. That is what it simply means. If you have a negative figure, that means the numerator was negative already, because your OPEX can never be negative. That means your selling price was lower than your variable cost. That is the only time you can have negative. But you cannot have a negative value. You cannot. So it's either you are going to have less than less than one, which is a loss. You may not even have a zero in the exam, less than one, or greater than one. And so you see here, industries usually use throughput to gauge whether their operations is giving them profits. So when they check their throughput accounting ratio and they say it's more than one, they now have an idea that all their operations are giving them a measure of profit. So that is how it is for throughput accounting. Okay, so there is this question here. There was this question here. It's a question number one question. Throughput marginal costing. November 2016, question one. November 2016, question number one. Let's look for that question. November 2016, question number one. Okay, so this is it. High Center Limited makes three products: soy, milk, and yogurt. I think this is one of the questions we solved when we were dealing with marginal costing. All three products must be offered for sale each month in order to provide a complete market service. The products are fragile and their quality deteriorates rapidly shortly after production. And we are told that the products are produced on two types of machine and worked on by a single grade grade of labor. And we are told that 50 employees are paid 80 naira per hour for a guaranteed minimum of 160 hours per month. So it means that they are paid 80 naira per hour, and they must be paid a minimum of 160, whether they work up to 160 or not. All the products are first pasteurized on a machine type A and then finished and sealed on machine type B. The machine hour requirement for each of the products are as follows. We have soy, milk, yogurt, and we have this here. Then we have the capacity of the available types of machine. We have 6,000 hours and 5,000 hours per month, respectively. Now, details of the selling price, unit cost, and monthly demand for the products are as follows. And these are these costs. Now, we are told that although High Center Limited uses marginal costing and contribution analysis, so what they're using is marginal costing for its decision. Profits are reported in a month management accounting using what? Absorption costing method. So they are using marginal costing to make decision. But when they want to make management account, they use absorption costing. Finished goods inventories are valued in a monthly machine management account at full absorption cost. Now, there are questions here. You are told to calculate the machine utilization rate for each product and explain which of the machine is the bottleneck or limiting factor. So I told you sometimes you see them called bottleneck and also call them limiting factor. So let's look at what machine. So I will use here. This is November 2016. That's my pen again. This icon. Let me use a different color to show heading. Icon past question. November 2016. Question 1. We are asked the A part. Machine utili- utilization rate and bottleneck. So that is what we want to look for. We want to look for the machine utilization rate, and we are told that we have two types of machine, machine A and machine B. So we'll take them in turns. Now say machine A. Sorry, I've cleaned the line. Let me draw it back. All right, so machine A. So let's look at machine A. We will now put the soyo, milk, and yogurt. So let's put SMY. So we'll call them SMY total. So what happened here? Hours per unit. So machine hours per unit. What's that? 1.5, 4.5, 3. 1.5, 4.5, 3. 1.5, 4.5, and 3. Then the next thing is units demanded or sales units or production units. Let me see what how the question calls it. Okay. Hmm. We have maximum monthly demand, right? We have maximum monthly demand. So is there another demand again? Okay, this is the maximum monthly demand. 1 to 700, 600. 1 to 700, 600. Let me write it. 1 to 700, 600. Monthly demand. This is in units. So this is total hours required. So this is the hours required here. 1.5 multiplied by 1,200. That will give us 1.8. This is 1,800. Then we have 4.5 multiplied by 700. That will give us 3,150. And the last one will give us 3 multiplied by 600. That will give me 1.8. This is 3.0. All right. So when you add them, 1.8, 1818 will give you 36. 36 plus 3,150 will give you 6,750. Right? Total hours required. Then we have hours available. How many hours is available for A? Capacity of available machine type. Okay, the capacity of the available machine type A and B are 6,000 hours for A. So we have 6,000 hours for A. We have 6,000 is available, and we required 6,700. So what's the difference? That means difference is 750, which is shortage. Shortage of hours. So if your hours required is more than what is available, then this is a constraint. This is a constraint. I said there may be more than one constraint, but the key constraint is the bottleneck. So let's check if machine type 2 or type B have shortage, and if the shortage of hours is more than A, then machine type 2 will be the key constraint. So let's look at machine type 2 or machine B. Machine B, you also have your SMY. SMY, then we have our total. Then we have our machine hours per unit. What is that again? 1, 2.5, 2. Then we have demand, monthly demand. Of course, the same monthly demand that we need here. 1, 2, 700, and 600. 1, 2, 700, 600. Then this is machine hours required. So this will give you 1,200. Let's see, 2.5 multiplied by 700, and that will give me 1,750. Then this is 6 times 2 as 1,200. It's 1,200. 1,002 plus 1,002 is 2,400, plus 1,000 will make it 3,400, 4,150. You should give me 4,150. Now, what is the hours available? Machine hours available. Machine hours available here for machine type 2 is 5,000. So hours available is 5,000. So what's the difference? The difference here happens to be 850, and that is excess or surplus hours. So it means that machine A is the bottleneck. So machine A is the bottleneck. So let's see how the solution is being given here. Let's compare the solution you have here with what I have given out here. That's their question number 1. So you see the same thing we did here. Okay, so we use a different way to get what do they call that? We use a different way to get our bottleneck. But they said machine utilization rate. Okay, so look at what they mean now. Machine utilization rate. Machine utilization rate is going to give you a look at machine A, machine B. We have hours required. Hours required in machine A was 6,750, 6,750, 6,750. Here was 4,150. Hours available. This is 6,000. And this is 5,000. Then utilization rate. Utilization rate. Did you write that well? Utilization rate. Utilization rate is going to give you this divided by this times 100. So 6,750 divided by 6,000 multiplied by 100. So that is 112.5%. 112.5%. Whereas this other one here is 4150 divided by 5,000 times 100. That's 83%. 83%. So it means that this is the bottleneck. So once your utilization rate is more than 100%, then it means that you are using more hours. You need more hours than you already have. So the other one is less than 100. It means you are only using 83% of what is available. Whereas the one of 112.5 is you need more than what is available. You need much more. So that's why you can use the utilization rate method, like the question asked, to get your bottleneck, or you can use the shortage or surplus method, which I did before, to get your bottleneck. But this is what the question was asking you to calculate machine utilization rate. Then the question went on to say that we should use the current system of marginal costing and contribution analysis to calculate the profit maximizing output of the three products. So what they are telling you is this: using your marginal costing system to find the maximum profit that you will make and which quantities you will produce. Now, this is telling you to do limiting factor. So, this is limiting factor. So, this B part is limiting factor. That's what this B part is telling you. So, what do? We say profit maximizing output using marginal costing. Okay, so this is what we'll do. The B part, B, profit maximizing output using marginal costing method. So that's the B part. So we will now remember or activate our limiting factor that we learned before. So this is SMY. We can still retain our total. Then the first thing to do is to look for our contribution per unit. Are we giving contribution per unit? Let's see. Okay, we have to derive our contribution now per unit. So what we'll do, selling price. So we have selling price, naira. What do we have? 910, 1740, 14. So that's your selling price. Then your variable cost. You need to now find your variable cost. So you will now say this is your selling price less variable cost. So you will now list your variable cost. Your variable cost will be Concentrate cost, that's a kind of material, that's a major material. Concentrate cost 220, 220, 190, 160. That's a concentrate cost. Then we have other material. So for you to have other material costs means this one is a major material. So what is that other material cost? We have 230, 110, 140. Somebody's asking a question. Let me see. How do we ascertain they are asking us to calculate limiting factor in question B? Because they made mention of profit maximization. Okay, so the reason why we are asked why we are using marginal costing, because they said High Center Limited uses what? Marginal costing and contribution analysis as the basis for decision making. Now they are now asking, use current system of what? Marginal costing and contribution analysis to calculate. So that's the reason they say use current system. What is the current system? Then I explain that it is marginal costing and contribution analysis. That's why we are using the contribution analysis. And throughput is also contribution analysis method. Because here we are also analyzing the contribution. So we said this is um sorry, this is 230, 110, 140. 230, 110, 140. Okay, so that's other material. So let's check if labor cost is given to us. Direct labor cost 80 naira per hour. Hmm. The significance of that will be given to us. Okay, so we have 60 naira direct labor cost. Let's write it down: 60, 480, 360. 60, 480, 360. So this is direct labor cost. Then is there any other variable cost that is given to us here? Ah, so we will now have to add our get our total variable cost per unit. So what do we have here? So let's take this here. 220 plus 230 plus 60. And that's 510. That's 510. 510. I'll be doing it immediately. Then this is contribution. Contribution per unit. I'll be doing it immediately. So contribution per unit, we have 510. Take it away from this 910. That will give us 400. So that will give us 400 per unit. So let's do the second one. Let's do the second one. We have 190 plus 110 plus 480, that gives us 780. 780, so I'll write it variable cost 780. Then what is our contribution? Do that immediately. Take it away from 1740. That gives us 960. So that's 960 here. Then we'll do the last one. We have, I write this well, is it 160? Yes, it's written well. So this is 160, 160 plus 140 plus 360. That gives us 660. 660. Let me write this well so that it will reflect that it's 160. So this is 660. Okay. Take it away from 14. Take it away from 14. And that gives us 740. So this is 740. This is our contribution per limiting factor. The contribution per unit, sorry. Then we will now say bottleneck. Bottleneck per unit, or you can call it limiting factor per unit. Anyone you call it is okay. Now we know that this is machine type A. We know it's machine A hours per unit. What is machine A hour per unit? We know 1.5, 4.5, and 3. So this is 1.5, 4.5, and 3. So we are going to be dividing. So when you do that, what do you have? 400 divided by 1.5. That will give me 266.67. 266.67. So this is your contribution per limiting factor. Okay, so of course here we'll have our ranking. Down here, but let's finish with contribution per limiting factor. Then we have here 960 divided by 4.5, 213.33. 213.33. Then we have the last one, 740 divided by 3. That will give you 246. 246.67. So this is now your ranking. This is what should be concentrated on first to produce. Second, and this is the third. Based on your ranking, you do S before Y, then before M. So your production, production output. So now we'll come here. This is my rank. This is my um, item. This is my quantity. This is my machine A as per unit, total machine A as contribution per unit, total contribution. So I have my ranking first, second, and third. Okay, this is my first, second, and third. Okay, so what I'm going to do now, I was told to do S Y. Okay, is it S Y? S Y M. S Y and M. So let me put all the things that I know first. Contribution per unit for S, 400, so it's 400, 740, 960. 400, 740, 960. So these are their contributions. Because I will now know here that our total machine hours should not exceed how many? 6,000. So this is the number of hours that we should not exceed. Now, what is our demand for S? Our S demands that we produce 1,200. So let's check 1,200. And what is the machine utilization hours for SYM? SYM, we have put it now, 134.5. 134.5. So when we multiply 1 by 1,002, we have 1,002, which is still less than 6,000, so it's okay. So we now say 1,200 multiplied by 400 naira per unit, that will give us 480,000. All right. Now, what's the requirement for Y? Y, we are told demand is 600. So let's try 600 here. 6 times 3 will give me 18. If I add 18 to 12, 1,000 plus 1,000 is 2,000. If I add 800 plus 200 is another 1,000, will give me 3,000, which is still less than 6,000. So with this now, 3,000 has been utilized. So the only thing that can come here is 3,000, balancing figure. The only thing that can come here is 3,000. Why am I doing this now like this? Is because this is the only thing remaining. Assuming this is not the only thing remaining, I will still be testing. But I just know that this is the only thing remaining. Now I have 1/8 here. So it means here that 600 multiplied by 740, 600 multiplied by 740 will give me 444,000. Now if you go to M says we should use 700. Assuming this was 700, okay? If I multiply 700 by 4.5, I will surely get something more than 3,000. Sorry, 700 multiplied by 4.5. You see, I'm getting 3,150. So I can't use the whole 700. So I must use 3,000. So I'll come back and do the reverse. 3,000 now divided by 4.5. That will give me 666. I can say 666. So 666 is what I'm going to do, not the mark of the wild beast. 666. Now multiply it by 960. 666. I can as well do 667, but the reason why I'm taking 666 because I cannot approximate it to one full whole number. Because for us to approximate, it means hours is involved. So even though I'm getting 666.67, I'm rounding it down to 666. I'm not rounding it up. That's why I didn't use 667. Because 667 multiplied by 4.5 will give you over 3,000. So if I do 667 multiplied by 4.5, to give you over 3,000. So I simply use 666, even though it's going to give me lesser than 3,000. I'll take it that way. The remaining 3 hours was used in making that 0.6 is a work in progress. We can decide not to use that work in progress time to do anything. So we just make 666 instead of trying to do the one that will make it 667. We let the machine rest for just 3 hours. So we say 666 multiplied by 960. That I do multiplied by 960. That will give me 639,360. So what's going to be your contribution? So I will say plus 444,000 plus 480,000. That will give me 1,563,360. So this is your contribution, total contribution, total contribution. Okay, so you want to know whether you made a profit, you now have to do your overheads, your overheads, your overheads. Now, how will you get your overheads? So let's see, you now decide to say overheads. overheads you are now using. Let me even see if the question is sum up to overhead. Let's see. Okay, I missed something here. I missed something. 1, 2, and 1, 8. How did I miss? Let me see what they did here. 1.5 and 3. How are they using 1.5? Machine type A. Oh, it's 1.5 and not 1.0. I'm the one who missed something here. Uh-oh, I missed something. It's 1.5 and I use 1. Okay, I can correct it now. It's small thing to correct. So this is 1.5. 1.5 times 12 is 1/8. And so if this is 1/8, that's 3/6. What can only be here will be 2,400. 2,400. Okay, so 1, 2 multiplied by 400 doesn't change anything here. So this is 2,400 divided by 4.5. 2,400 divided by 4.5. That gives us 533. Okay, that gives us 533. So here is 533. If I multiply it by 960, 533 multiplied by 960, that should give me 511,680. 511,680. So if I recalculate this, 511,680 plus 444,000 plus 480,000, this should give me 1435,680. 1435,680. This is your contribution. Don't need to calculate overheads. So what they are asking you is the profit maximizing output. Profit maximizing output. So this is the output that will give you the greatest profit. So this is the output that will give you the greatest profit to produce this, and this. And this is your greatest contribution. The ICAM question, they didn't show their contribution, they only showed the output, which is what the question is even asking you. Then the C part was saying, explain why throughput accounting might provide more relevant information in the high center circumstance. So let's read what the answer is here. Explain why throughput accounting might give a better explanation. They said a major concept underlying throughput accounting is that the majority of the cost except material and concentrate costs are fixed. In high centers case, it is clear that the labor cost, which is treated as a variable cost in the traditional marginal costing, is indeed a fixed cost. How do we know it's a fixed cost? Look at the statement they made. They said that 50 direct employees are paid 80 naira per hour for a guaranteed. This guaranteed also makes it look at a fixed cost of 160 hours per month. So now you're saying here that the employees are paid a guaranteed of 8,000 hours, meaning that 160 times 80 to make it here 160 hours times 80. So, sorry, then multiplied by 50. Sorry, 80 naira per hour, and they are paid for 160 hours. That's 12,800. Let's see what they got here. 160 times 50 each month. I wonder why they got this 50. Okay, 160 hours times 50 employees. Okay. Oh. They are paid 160 hours per employee. Okay, see what they did now. 160 hours per employee, and there are 50 employees. So they are paying for 8,000 hours. 8,000 hours each month. That is what they are paying for. So whether machine A or machine B do not use up to 8,000, they are going to pay for 8,000 hours. Whereas the number of labor hours required to meet the maximum demand is 7,800. How do we know? Maximum demand. When we calculated in our other method we use in calculating, when we this is hours required. Okay, no. Let's see how they calculated years. Labor hours, maximum demand. Okay. Oh. I get it now. You know when we did this for machine A, machine B, okay, this machine B 4,150, machine B. Okay, this is per unit. Oh, this is per unit. Hours required to make the unit. So let's see what they did here. Labor hours per unit. Labor hours per unit. How this 0.75 was gotten here. Let me show you. This is the number of, this is the cost per unit, 60 naira. So if they are paying you 80 naira for 1 hour and you spend 60 naira, so this simply is 60 over 80 to get the number of hours. So 60 divided by 80, that's the 0.75 here. So that's 0.75. So this will be 480 over 80. 480 divided by 80, that should give you 6. Yeah, this is 360 over 80. 360 divided by 80, that should give you 4.5. So this is the number of hours re required for, so this is what they paid per hour, 80 naira. This is what they paid for. This is the number of units. This is the number of hours. This is the number of hours required to do one unit. 0.75, 0.6, 0.45. So what they did here is that this is the labor hours required to make one unit for each of them. Look at their maximum demand. And when you multiply by these hours, you have 900, 42, and 27. When you add them together, what is required is 7,800. But you are paying them minimum of 8,000 hours. So it shows you that the marginal costing method is not even looking at correctly looking at labor as variable, because labor should have been paid at 7,800 hours, but they are paying for 8,000 hours. So therefore, labor is a fixed cost that will not alter within the relevant range of the activity. But when we use throughput, it will recognize this in the calculation. So now the D part is asking us to look for, use the throughput approach to calculate the throughput maximizing output. So what will you do in throughput approach, which is in D? In D, we are asking for throughput approach to profit maximizing output. So we now said B is still going to be S, M, Y, and total. Okay, S, M, Y, and total. So this is your X, M, Y. Okay, so we have our selling price 910, 1740, 14. 910, 1740, 14. That's our selling price. So you now have your variable cost. So we are lessing variable cost, and it's going to be concentrate costs. What's our concentrate cost? 220, 190, 160. 220, 190, 160. Then we have other material, other material costs. You know, the first one was 230, 110, 140. Okay, so when I add this, this is already 300. This is already 300. And this is 450. How am I now writing this thing well again? This is 450. So that's your variable cost. Then we have throughput. So your throughput, first one will be 910 minus 450. That will give me 460. Then we have 1740 minus 300. That will give me 1440. Then we have 14 minus 300. That will give me 110. Is it 110? 1100. That's throughput. Then we'll bring our bottleneck per hour. Our bottleneck per hour is machine A. Machine A. I have to be careful with the figures I use here. Machine A 1.5, 4.5, 3. 1.5, 4.5, and 3. So this is your throughput per bottleneck hour. So we have 460 divided by 1.5. That gives me 306.67. 306.67. The next one is 1440 divided by 4.5. That gives me 320. Then the third one give me 1100 divided by 3. That will give me 366.67. So now this is your throughput per bottleneck hour. Then we can do a ranking. Now this is going to be the first. This is going to be the second. This is going to be the third. So what is going to be your profit maximizing output? So before we did SMY, so SYM before, now it is YMS. Is it YMS? Yes. YMS. So Y, okay, Y, M, S. So this is first, second, and third. So this is your rank, product. This is quantity. This is machine A, hours per unit, total hours. Then we can have our contribution per unit. We have our total contribution as we did before. So we knew that our total contribution for Y, let's put all the things we know before, 740, 960, 400. 740, 960, 400. 740, 960, and 400. Let's also put the other things we know. 3, 4.5, 1.5. 3, 4.5, 1.5. 3, 4.5, 1.5. We also know that here should give us 6,000. Okay, so let's go. What's your quantity for Y? Y was 600. So take 600 here. 600 times 3 will give me 1/8. All right, like we did before, 600 multiplied by 740, that will give me 4440. 4440. All right, and look at M. What's the M? 700. 700. So I'll take here 700, and I multiply 700 by 4.5. That give me 3150. 3150. If I add 3150 plus 1/8, that should give me 4950, right? If I have to remove this 4950 from 6,000, 6,000 minus 4950, that should give me 1050. 1050, that is my balancing figure. I can come here and say 1050 divided by 1.5, and that will give me 700 as against 1, 2. So this will give me 700. So here, 700 multiplied by 960, first one, that will give me 672,000. Now let me do 700 multiplied by 700 multiplied by 400, that will give me 280,000. So if I were to add this together, 280 plus 672,000 plus 444,000, that will give me 1396. 1396,000. If we were to compare this with what we did before, This is giving me 1435, which is higher than what we did in the throughput. But throughput gives us a more realistic figure here because the labor was paid higher than what we worked at. So, but now, yeah, is saying here, this shows here that using the contribution analysis method will give you a higher contribution indeed. But using the throughput method, you get something lower than that, but this gives you a more realistic picture from what we've seen above. So this is what you have to produce: 600, 700, 700, as can be seen in their solution. 600, 700, 700, as can be seen. Okay. Then the other part of the question is saying, explain the throughput accounting approach to optimizing the level of inventory and its variation. Contrast this approach to the current system employed by High Center. They are told to explain the throughput accounting approach to optimizing the level of inventory and its valuation. Look at what they said here. The conventional cost accounting approach used by High Center views inventory as an asset. So that's the theory of throughput. In the throughput approaching accounting approach, inventory is not viewed as an asset, but rather as a result of unsynchronized manufacturing. The existence of inventory is thus viewed as a breakdown in synchronization and a barrier to generating profit. In throughput accounting, the ideal inventory level is zero, with the exception that a buffer inventory should be held prior to the bottleneck machine. What I mean by a buffer inventory is something that you use to fall back on when there is a bottleneck. Just like when we are treating um, inventory valuation, we have what they call a buffer stock, which is that stock that from your minimum stock until when you get your new supply, that stock there is a buffer stock. All right, so that's the kind of thing they mean here. They now said here again that as regards the valuation of inventory, the throughput philosophy is that no value is added to the inventory items and no profit is earned until the items are actually sold. The inventory is valued at its material cost until it is sold. If it is not sold, the cost of raw material is what the inventory is. If it is sold, then we can be talking about the variable cost or the cost of sales. The approach to inventory valuation is the contrast to the full absorption costing used by High Center. The latter approach, which is the absorption costing, encourage managers to produce outputs just to add to work in progress or finished goods inventory, since this helps with the absorption of overhead and boost profit reports. If you are making profit, if you are making product, if you don't sell it, it boosts your profit in the sense that you close them as closing stock. And when you close them as closing stock, the higher your closing stock, the higher your profit. This behavior will be avoided in throughput, and managers will be more likely to be willing to optimize inventory if this is valued at material cost only. So if your inventory is valued at material only, then you find out that this will be discouraged. But because in traditional costing, it is valued at production. So they keep producing, and your closing stock is valued at production cost, like we see before in that template. You found out that it boosts your profit, which is a false profit. So that's what we can take for today. We've come to the end of our class for today, throughput accounting, and it has been a very, very wonderful session. In our next class, we'll be taking maybe target costing, so that we can see some of these costing methods and get acquainted with it. So that's all we can take for today. Please go and practice some of these questions. Look at some other questions that has to do with throughput accounting. Okay, try and check for throughput accounting and see how they are being solved. I don't think in this place you can see another throughput accounting except the one we just solved. But you need to look for a more modern question, more current question, to see how throughput accounting can be solved. Next class we might either take target costing or life cycle costing. I think more life cycle costing might be more appropriate because we talked about learning curve that has to, we now spoke about life cycle. So I think life cycle costing will come and target costing. So thank you so much for the class, for attendance. See you again in the next class.